Welcome to The Explainer. Today, we are cracking open one of the most influential investing books ever written, Philip Fisher's Common Stocks and Uncommon Profits. We're going to use the book itself, plus a really revealing foreword by his son, Ken Fisher, to uncover not just a powerful method, but the shocking paradox of the man who created it. You know, this single quote right here, it basically captures Fisher's entire philosophy. It's a challenge to all of us, right? A call to look past the flashing numbers on the screen and ask a much, much deeper question. What is a business actually worth? And you see, that leads to the biggest problem for any investor. In a world just drowning in data, how on earth do you find that tiny handful of truly game-changing companies? Well, Fisher believed the answer wasn't in the public reports. It was hiding in what he called the business grapevine. To solve that problem, he came up with this really unique, kind of elegant method he called Scuttlebutt. So, what exactly is it? Okay, so the idea behind Scuttlebutt is deceptively simple. Fisher's whole argument was that the most valuable information, the real unvarnished truth about a company's strengths and weaknesses, that's never going to be in an annual report. Nope. It's found in those candid, off-the-record conversations with people who live and breathe that industry every single day. This quote just nails the method in action. See, this is less like financial analysis and honestly a lot more like investigative journalism. He was convinced that if you just piece together all these different perspectives, the real story of a company's competitive edge or, its lack of one would become crystal clear. And let's be clear, this was never just a random chat. It was a systematic investigation. Every single conversation was a piece of a bigger puzzle, all designed to build this complete 360-degree view of how a company really operates, far, far away from the polished press releases. So with all this scuttlebutt, what was Fisher even looking for? Well, he was hunting for the answers to his legendary 15-point checklist. Now, this was not about finding a stock that looked cheap this week. No way. These questions were a qualitative blueprint for finding businesses with real, durable, long-term advantages. I mean, he was digging for stuff you just can't find on a balance sheet. He didn't just ask if a company had R&D, he wanted to know how effective it was. He didn't just look at profit margins, he asked why they were high and what the plan was to make them even better. The man was hunting for greatness. And here's what's so wild. The framework was so solid that it could be used for totally different investment styles. You had Philip, the father, using it to find the next huge growth story. But then his son, Ken, used the exact same 15 points to find high-quality companies that the market was just unfairly beating up. The Nucor Steel example shows this perfectly. So back in the 70s, Ken Fisher uses the 15 points, identifies Nucor as this awesome, undervalued company, and makes a huge profit. Well, his father sees the long-term potential his son uncovered, buys in, and then just holds on for decades. And he ends up making a vastly larger fortune. Same method, different timelines, both with incredible results. Okay, but this is where the story takes a really fascinating turn. Because the man who pioneered this forward-thinking, innovation-obsessed method was, in his own personal life, completely and utterly allergic to change. This is the core paradox of Philip Fisher. Professionally, he was the apostle of constant change and innovation. But personally, he was a man of extreme rigidity. He lived in the same sparse house his entire adult life, a place where, his son says, even just moving a piece of furniture was a major, major event. This one little story from his son Ken says everything. A simple tech upgrade in his own office, something that would make his life easier, made him furious for months. Can you imagine? He saw it as a totally unacceptable disruption to his world. And right there, that reveals the deepest insight of his life. Fisher's genius wasn't that he was some natural innovator. It was the exact opposite. His genius was that he built this disciplined, rigorous system that forced him to look for qualities in companies that he himself totally lacked. The method was basically a shield against his own powerful personal biases. But, even the most perfect method has its limits. And Fisher's final chapter shows us the ultimate threat to any long-term strategy: the investor themselves. His son gives this incredibly blunt warning, and you can just feel the pain behind it, born from watching his own father's brilliant mind slowly fade. It's a humbling thought that even the sharpest intellect has an expiration date. For decades, this was his gospel. The entire point of the Scuttlebutt method, of the 15 points, was to find those few incredible companies that you could just confidently hold on to for a lifetime, through all the ups and downs. But this timeline, it shows the tragedy of what happened next. Through the 70s and 80s, he totally practiced what he preached. He concentrated his money into just a handful of the best businesses on earth. By 1990, he was down to just 6 stocks. I mean, think of the conviction that takes. But then, as dementia slowly took hold in the late 90s, he started to abandon the very discipline that made him a legend. He began to fiddle and fix, second-guessing these brilliant decisions he had made decades earlier. And the price he paid for this fiddling, oh, it was immense. He sold his long-term holdings in generational companies like Texas Instruments and Dow Chemical. These were the poster children for his entire method, businesses he found through deep research that were meant to be held forever, and he just let them go, usually at the worst possible time. And this right here is the final, powerful lesson from his life. A brilliant strategy is only as sound as the mind that's executing it. The single greatest risk to your portfolio might not be some external market crash, but the slow, quiet erosion of your own ability to make good decisions. So what do we do with all this? How can we take these hard-won lessons from Fisher's uncommon life and actually apply them to how we invest today? Well, his whole legacy can really be boiled down to 3 pretty simple, actionable rules for any of us who are looking for those truly uncommon profits. Here's how you can actually put them into practice. First, try a little scuttlebutt. I mean, even one conversation with someone in the know is better than none. Second, codify your method. Actually write down your rules. It protects you from your own emotional whims, just like it protected Fisher from his biases. And finally, the toughest one. Plan for your own limits. Decide ahead of time at what age you're going to hang up your cleats and just let a simpler strategy take over. And that's really the final question Philip Fisher's story leaves us with. It's a powerful reminder that truly successful investing, it requires more than just a brilliant method. It demands profound and sometimes pretty uncomfortable self-awareness.